Hello, everybody, and welcome to the video for topic 4 of Advanced Financial Accounting. This topic deals with investments in associates. So, investments in associates is an example of a strategic share investment made with an intention to obtain significant influence. Strategic share investments cover various kinds of investment intentions, including the obtaining of significant influence all the way to control. If control existed, then that would be a parent-subsidiary relationship and would call for consolidation. We will be learning about consolidation in later topics. For strategic share investments, the financial reporting standards that apply include IAS 28, which deals with investments in associates and joint ventures, IFRS 10, which deal with consolidated financial statements, and IFRS 11, which deal with joint arrangements. Here's a look at the accounting for strategic investments. The discussion is based on an illustration taken from Intermediate Accounting, Volume 1, 7th edition by Beatty et al., copyright in which rests with McGraw-Hill Ryerson Limited. The accounting for strategic investments depends on the type of that strategic investment, whether it's a control investment, a significant influence investment, or a joint control investment. And essentially what we'd be looking at is the share investment and the level of ownership. So starting with control, if the investor owns more than 50% of the voting shares of the investee company, then the investor assumes the role of a parent and the investee company becomes a subsidiary. If the investor has 20% to 50% of the outstanding voting shares, common shares in the investee company, then typically the investee is seen as an associate of the investor company. If the investor has joint control over the investee company, then it's essentially a form of a joint arrangement. And then what needs to be seen is whether the joint arrangement gives the investor a right to the net assets of the investee company. If so, then it's a joint venture. Or whether the investor has direct rights to assets and obligations for liabilities of the investee company, in which case it is a joint operation. For an investment in associates, we use the equity method of accounting for the investment. For an investment in a joint venture, we use the equity method as well. For an investment in a subsidiary, we apply consolidation. And for an investment in a joint operation, proportionate consolidation is used. We will be learning about investments in associates in this topic. We would look at investments in joint ventures in the next topic, topic 5. And then we will look at consolidations, investments in subsidiaries and consolidations in the next few topics, topic 6, 7, and so on. At a later topic, we will also look at joint operation. So here's a deeper look at the equity method. The initial recognition of the investment is at cost. Cost will include any transaction costs such as brokerage fees, commissions, and so on. If the investor has obtained significant influence over time and had owned shares in the associate prior to obtaining significant influence, and any existing shares need to be revalued because the investor must have been using the fair value through profit or loss method earlier because the investment was a passive investment before. And now that the nature of the investment has changed over to become an investment in an associate and the equity method must be used, the existing shares need to be revalued, and any resulting gain or loss must be recorded in net income. The investment income from an associate is basically the proportionate share for the investor in the associate's net income. So for example, if the investor owns 30% of the common shares of the associate, then 30% of the associate's net income will be the investment income for the investor. Now, this proportionate share has to be adjusted for a few things: for amortization of fair value differences, for any goodwill impairment, and for realized and unrealized intercompany profits. It's also important to note that the investor must report its share of the associate's discontinued operations as well as other comprehensive income, and each of those amounts must be reported in the appropriate category. So if the associate reported discontinued operations, the investor will report its share of the discontinued operations profit or loss under discontinued operations. And also for OCI, if the associate reported any other comprehensive income, the investor will report other comprehensive income on its own statement of comprehensive income related to its share of the associate's OCI. Under the equity method, dividends received are not seen as income. Dividends are not income. Rather, dividends are seen as a return of the investment in the sense that dividends will reduce the investment account. Fair value gains and losses do not apply because an investment in associates is not remeasured for fair value. If the fair value number is available, then it is disclosed as a note disclosure, but no actual adjustment is made to the investment account. If, however, the investment were to be sold for whatever reason, then any realized gain or loss must be reported in net income. From time to time, the investment will be assessed for possible impairment. And if the recoverable amount is found to be lower than the book value of the investment, then an impairment loss is recorded as part of net income. Let's take a look at some calculations under the equity method. First up, the calculation of the investment income under the equity method. So under the equity method, the investment income is the investor's share, so investor's ownership, of the investee's net income. Now, if the significant influence was obtained sometime during the year, so not at the beginning of the year, sometime during the year, then for that year, the year of acquisition, the share of the investee's net income must be prorated for the partial year during which significant influence existed. That amount has to be adjusted for the amortization of fair value differences on depreciable assets and long-term liabilities with a maturity date. Any goodwill impairment losses if determined, will be adjusted against the investment income. And we will make an adjustment for an intercompany unrealized profit on an after-tax basis if the transaction occurred in the current year, and any realized intercompany profits from previous years on an after-tax basis are added. The sum of these various adjustments to the investor's share of the investee's net income is the investment income under the equity method. Next, if we were to take a look at the investment account under the equity method, it's a simple continuity schedule where you start with the beginning balance of the investment account, assuming it was calculated under the equity method, add the investment income for the current year as calculated under the equity method, basically the calculation that we looked at above. And keep in mind that dividends are not part of income, so any dividends received are deducted from the investment account. Any dividends received from the investee are subtracted from the investment account to get the ending balance of the investment account under the equity method. The cost method is not allowed for external reporting under IFRS, but companies will often use the cost method for internal record keeping. So here's a look at how the cost method operates. The initial recognition of the investment is at cost, and that will include transaction costs. This is no different from what we would have done under the equity method. So there is no difference between the equity method and the cost method for the initial recognition. However, dividends received from the investee are recorded as income. Under net income, they're recorded as dividend income. This marks a difference between the cost method and the equity method, because under the equity method, you'd recall that dividends are seen as reducing the investment account. And any fair values, gains and losses are not applicable under the cost method because we do not remeasure the investment to fair value at the end of the period. So this again is no different from the equity method. So for companies that use the cost method for internal record keeping of investments in associates, the adjustment that they must make to convert from the cost method to the equity method essentially deals with reversing any dividend income that has been recorded in net income and replacing it with the equity method investment income and including that as part of the investor's net income. Here's a look at the conversion from the cost method to the equity method. For the statement of comprehensive income, we will calculate investment income as shown earlier. And if the cost method is used, any dividends received from the associate will have been recorded as income. So we must then adjust for those dividends and take them out from the investor's income. Now, in some cases, in certain problems, you are asked to perform a catch-up calculation for the investment account several years after the date of acquisition. This is somewhat unrealistic, but think of it as maybe, you know, the investor should have used the equity method, but for whatever reason did not. Okay, so a situation might be, okay, you know, they were reporting under ASPE, and ASPE allows companies to use the cost method when fair value information is not available. So a private company has significant influence over another private company, ASPE permits the use of the cost method in that case. Now, let's say the company is planning on going public and must then move over to IFRS. So if that were the case, then they'll have to do a catch-up calculation because they'll have to do a switch over from the cost method to the equity method. And if we were to apply that adjustment on a retrospective basis, then the calculation of the investment account is done in the following manner. We start with the investment account at cost and add to it any change in the investee's retained earnings since the date of acquisition. So whenever the significant influence was obtained, from that point up to the current year, whatever has been the change in the investee company's retained earnings, we calculate the change, and the change could be positive or negative. We will add or subtract the investor's share of the change in the investee's retained earnings accordingly. Then we subtract any unrealized intercompany profits on an after-tax basis as of the date of the calculation. So any ending balance of unrealized after-tax intercompany profits. We will also subtract the accumulated amortization of fair value differences and any accumulated goodwill impairment losses up to the date of calculation. So making those adjustments to the investment account at cost gives us the investment account balance as per the equity method. We will, when we look at the in-class examples, look at an example of something like this. So investments in associates indicates the existence of significant influence. If an investment in another company's shares gives the investor significant influence over the strategic, operating, investing, and financing activities of the investee, then we call that investment an investment in associate. And according to IAS 28, paragraph 5, usually a holding of more than 20% and up to 50%. So more than 20%, up to 50% of the voting common shares is indicative of significant influence. However, this is a guideline and not a rule. It may be possible for significant influence to exist with fewer than 20% of voting shares, and that will be the case if the rest of the shares are widely held by other parties. So no other party really has any significant chunk. So even with perhaps 15% of the voting shares, the investor may be able to wield significant influence. And it's also possible that even in spite of the fact that the investor owns more than 20% of the voting shares, they may not have significant influence over the investee company. And that would be the case if, say, some other company has control over the investee. Some other company owns more than 50% of the shares. And if that other company is unwilling to work with us, the investor, then in spite of owning more than 20% of the voting shares, we will not be able to exercise significant influence. So it's a matter of fact. So if nothing is given, assume that ownership of more than 20% but less than 50% gives significant influence. However, if other factors are mentioned, then we ought to pay attention to them. What are some of the other factors that will indicate significant influence? IAS 28, paragraph 6 says that significant influence, the existence of it, is supported by facts that would include the investor company having representation on the board of directors of the investee, the investors' participation in key policy-making processes of the investee company, there being material transactions between the investor and the investee company, there being an exchange of managerial personnel, key managerial personnel, not at a supervisory level, but say at a controller level or higher, and the provision by the investor of essential technical information to the investee company. So if any of these other factors are present, then they will be supportive of the investor being able to wield significant influence over the investee company. And so therefore, the investee company will be seen as an associate, and the equity method should be used for accounting. Changes in accounting methods, either to the equity method or change from the equity method, must be accounted for prospectively. So there is no retrospective adjustment. The investment is measured to fair value at every such instance. And if the investment were to be sold, the realized gain or loss is included in net income. And when calculating the cost of the investment for a partial sale, the average cost is used. We do not remeasure investments in associates to fair value. However, if the fair value is readily available, then this amount should be disclosed by the investor company in its notes. That concludes the lecture video for topic 4, investments in associates. We will take up examples in class.